Now, short-term capital gains rates are the same as your ordinary income rates. And that's important because ordinary income rates, especially for a high income earner, are often higher than long-term capital gains rate. For example, let's say we have a couple that files their taxes married filing jointly and they have a $300,000 income. If they had a long-term capital gain, meaning they'd held that investment for at least a year and a day, they're going to pay 15% in capital gains tax. But if it's a short-term capital gain at their ordinary income rate, you will see that at that $300,000, it's 24%. So the difference between selling it before a year and a day and after a year and a day is the difference between them paying 15% in taxes and 24% in taxes, which is why there needs to be some planning involved for when you sell appreciated property. But that's not the only tax that they may be subject to as a high income earner. There's also the additional Medicare tax, where for singles above 200,000, for couples married filing jointly above 250,000, you owe an additional 0.9% on all of your income above those levels. And investment income, like a capital gain, is considered in that amount. You also have the net investment income tax. It's the same amount in terms of who's subject to this tax, but that's an additional 3.8% on income that's earned from an investment nature. That's things like the interest on your bank accounts. It's also things like your investment income when you sell an asset at a gain. So there's a lot on the line when you sell an asset in terms of taxes. You could owe short-term capital gains tax, long-term capital gains tax, you could owe additional Medicare tax, and you could owe the net investment income tax. But what if there was a way to avoid all of those taxes by, instead of selling an asset for a gain, donating that asset to a nonprofit entity? And that's something that can be done. So going back to our example, we have someone who bought 10 shares of stock at $1,000 a share, and it has grown to $1,500 a share. There's $500 of embedded gains in each share of that stock. Well, maybe this person is charitably inclined, and they decided that they wanted to donate $1,500 to a charity of their choice. Now, typically, a person would do one of two things. They might have $1,500 of their own, and they give that $1,500 to the nonprofit, and maybe they get a deduction based on how they file their taxes for that contribution on their tax return. The second option would be they might sell that share of stock for $1,500, pay capital gains tax on the $500 worth of gain, and then donate whatever is left to the nonprofit after the tax has been paid. But what if, rather than doing either of those options, they instead decided to donate the share of stock directly to the nonprofit? What happens in this instance is the nonprofit can sell the share on their end. And even though there's $500 of gain in that stock for you, the nonprofit pays no capital gains tax. And because you never actually sold it on your side, you pay no capital gains tax either. And if you're a high income earner, you also don't pay the net investment income tax or the Medicare surcharge tax. But not only that, you can turn around and take the $1,500 that you might have donated in cash and instead go buy that new share of stock that now has a price of $1,500. So what have you done? You got the tax deduction for the charitable contribution, and now you have reacquired that share of stock at a new cost basis of $1,500, meaning that you have functionally erased that embedded gain. And if down the line, the share of that stock that you initially bought at 1,000, then grew to 1,500, grows to 2,000, and you decide to sell again, your new cost basis was now $1,500 instead of the original 1,000 when you first bought the stock. And we'll put an article in the show notes about how you can donate appreciated property, but it often involves just a small amount of communication and coordination with the nonprofit, and many will already have an avenue set up to receive appreciated property such as stocks. It's just not many people know that it's an option that's available to them.